Welcome. This briefing outlines the essential processes for end-of-period financial reporting, based on the Learning Guide 05LG End-of-Period Financial Reporting Live. Our objective is to provide the necessary knowledge for producing reliable and compliant financial statements.
We will proceed through 4 key sections. We begin with foundational principles, then move to the construction of the primary financial statements, and we will conclude with the processes for ensuring data integrity.
Let's start with Section 1, Foundations of Financial Reporting. As stated in the Learning Guide, the core objective of this process is to ensure the accuracy and completeness of an organization's financial statements.
The source document specifies that this process is governed by standards issued by bodies such as the Australian Accounting Standards Board, or ASB. Adherence to these standards is mandatory to ensure consistency and reliability in all financial reporting.
We will now turn to Section 2, the Revenue Statement. The purpose of this statement is to detail an organization's financial performance over a specified accounting period.
According to the source material, the function of the revenue statement is to clearly show whether a business has generated a net income or a net loss during the reporting period.
The source guide provides the following example to illustrate this. For a small cafe with $10,000 in revenue and $7,000 in expenses, the resulting net income is $3,000. This figure is the direct measure of profitability for the period.
A fundamental principle of reporting is revenue recognition. The source guide outlines 2 methods. First, the accrual basis, where revenue is recorded when it is earned. Second, the cash basis, where revenue is recorded only when payment is actually received. This distinction is critical for accurate reporting.
Next, in Section 3, we will examine the balance sheet. In contrast to the revenue statement, which covers a period of time, the balance sheet provides a financial snapshot at a single, specific point in time.
The entire structure of the balance sheet is dictated by the fundamental accounting equation. Assets must equal the sum of liabilities and equity. This equation must always be in balance without exception.
The source specifies these 3 core components. Assets are resources the business owns. Liabilities are what it owes to others, and equity represents the owner's residual interest. These components are then further classified as either current, meaning within 1 year, or non-current.
This table, taken directly from the Learning Guide, demonstrates the equation in action. As you can see, total assets of $15,000 are precisely balanced by total liabilities and equity, which also sum to $15,000. Our final section addresses the processes for maintaining the integrity of these financial reports. We will now cover the systematic methods for identifying and resolving reporting errors.
The source document identifies several common errors. These include data entry mistakes, misclassification of items, and incorrect depreciation calculations, that is, errors in allocating the cost of an asset over its useful life. Any one of these can have a significant impact on financial accuracy.
To counter these potential issues, the Learning Guide outlines 5 specific techniques for the systematic detection of errors.
These 5 steps, from reconciliation to verification, form a robust, systematic process. For example, reconciliation involves comparing internal ledgers against external bank statements to find discrepancies. Verification, on the other hand, means tracing a number all the way back to its original source document.
Once an error is detected, the source provides clear correction methods. A typographical error requires a direct update in the report. A misclassified expense, however, requires a formal adjustment to the journal entry, which is the official record of the transaction, to assign it to the correct category. In addition to corrective measures, the Learning Guide emphasizes the strategic importance of prevention. The objective is to implement systems that minimize the occurrence of errors from the outset. To achieve this, the guide recommends 5 key preventative measures. These are using detailed checklists, conducting regular training, leveraging automated systems, performing internal audits, and implementing a segregation of duties. According to the source, these steps collectively ensure long-term financial accuracy.
The Learning Guide concludes by emphasizing a key strategic shift. By mastering these reporting principles, an organization moves beyond simply reacting to errors and progresses to a state of proactive financial management. This represents the ultimate objective of the processes detailed in this briefing.